Thank you for the great opportunity to share this discussion with you guys. Decentralized finance and ESG, the two most important topics in today's markets. So given the multidisciplinary nature of the audience, so let me first give you a quick overview of what is ESG, what are the key issues are, why should we care about ESG, and what are the challenges and opportunities in this domain. So first, what's ESG? So ESG investing is basically the practice of incorporating environmental, social, and governance considerations into investors' portfolio decisions. You may have also heard different names, such as responsible investing, sustainable investing, and CSR, corporate social responsibility. Okay? So there are three pillars to ESG as defined by the United Nations Principle of Responsible Investment. So the first one is environmental. Okay, so it's related to what kind of impact the companies have on the environment. So it talks about issues such as climate change, resource depletion, waste and pollution, deforestation, biodiversity, and etc. The second pillar concerns the way in which the companies deals with the people that they interact with, such as the employees, the employees' workers, customers, and suppliers. So the issues that's covered by the social umbrella involves working conditions, local communities, conflict, health and safety of the workers. Okay. The third pillar is governance. It's basically how the company is run. How do we, what kind of incentive structure we want to give the executives? How does the company, in terms of board diversity and the structure of the board? What's the company's tax strategies? So it has been a growing trend in the investment community to take ESG factors in their consideration when they do investment decisions. So from the investors' view, the investors are increasingly concerned with corporate sustainability. So to give you an example, the UNPRI, which I just mentioned earlier, is the world's leading proponent of responsible investment. It's launched in 2006 by the world's largest institutions. So this includes the pension funds, the sovereign wealth funds, the foundations, and investment managers. Started in 2006, it only had about 63 large institutions as signatories. By the end of 2021, the number has grown to close to 4,000 signatories, covering asset under management of more than $100 trillion. Another trend that we observe in my own research is that there has been a rising number of firms that specifically tie ESG targets in the kind of compensation contracts they give to their executives. So we show that in our paper, for the large firms in the developed markets, more than 20% of the CEOs are getting compensation contracts that's specifically tied to ESG goals. And this number is even bigger in the UK, who is actually at the forefront of responsible investment. So among the FTSE 100 largest companies in the UK, more than 45% of the CEOs have compensation contracts that's tied to ESG. And these are not just contracts with ESG components. These components are also substantial. In terms of the dollar terms, it amounts to an average weighting of between 15 and 16%. Another reason is that we've seen exponential growth in the number of regulations that was proposed regarding ESG. So just in 2018 alone, there are more than close to 200 new regulations proposed, affecting more than $30 trillion under investment. So the next question you may have is that, well, why should I care about ESG? Well, the first is that there's been a huge societal change in people's attitude towards environment, towards social, and towards governance in the last 10, 15 years. So this is referred to as the rise of the stakeholder capitalism, which means that the purpose of a corporation is not just to maximize its financial performance, but it should be responsible for all the stakeholders, such as the customer, such as the employees, the environment, and the local community. Okay, so. And adding to that, there's been a substantial increase in the number of investors, that they demand sustainable investment. Okay. And the second reason is that the focusing on ESG could be purely coming from a financial motive. Okay, so and that's referred to as doing well by doing good, or win-win. So the idea is that the ESG investing may actually be beneficial for the financial outcomes. It may give investors higher returns. It may help them reduce the risk, and the focus on the long-term sustainability helps to alleviate the short-term behaviors that managers may have due to agency problems, and therefore focus their actions on the long-term sustainability of the company. So some examples of why, what other cases where doing well can indeed be doing good for the company's financial interests. It could be that when you have better employee engagements, you have better employee. You have happier employees. They tend to be more productive, more innovative, which is good for the business. Okay, ESG also is good for the company's reputation. It helps them to reduce the litigation cost, helps them to reduce their regulatory cost. It helps them to avoid scandals. Focus on ESG, take ESG factors into consideration, also helps the company to manage their material exposure to climate-related risks, such as those associated with physical risk as well as transition risk. So the ESG investing is really a new trend that developed over the last 20 years. So as with all the new things, unavoidably there is going to be challenges and issues. So one of the major issues in this ESG universe is the issue of data and measurement. So the ESG is very difficult to measure, and the available data is quite noisy. So a major source of ESG data is reported by the company itself. So it's subject to certain biases and this concern of greenwashing. The other issue is that because a lack of consistent standard, that makes the ESG data hard to compare across different companies, hard to compare across different industries. And the other issue is that the ESG data is also missing, a lot of times missing for the small companies and companies in emerging markets. Now, one may say that, well, if looking at the self-reported data is problematic, maybe we can rely on the professionals, right? So we can look at the major rating agencies and use their data. So an issue is that the prominent, currently in the market, the prominent data providers, their ratings are actually not quite consistent with each other, so there's a great degree of divergence among the ratings. To give you an example, so the three top main rating agencies on the ESG data, the correlation between their ratings for the same firm, for the same category, is often below 50%. Okay, so that's quite low. To give you a benchmark, if we are looking at the ratings of corporate bonds by the major rating agencies, the correlation is often more than 90%. So this tells you how noisy the data could be, even when these data are produced by the professionals. Okay, so there are also other concerns and challenges. First, the next question is, can ESG investing be really a win-win, right? After all, where investors care about the financial performance of the companies, but also the stakeholder capitalism view says that the companies should also take into account the well-being of other stakeholders. So sometimes these different objectives may not be perfectly aligned with each other, and therefore companies face a trade-off. Okay, so how to address these trade-offs? The next question is, do ESG investing really lead to real corporate changes? So this is related to the kind of the greenwashing concern. Do companies simply tick certain ESG boxes, or do they actually materially change the way they conduct their real investment and their other real business practices? The next question is ESG investing truly helpful to achieve the societal goals in aggregate, right? Because sometimes when a state passes through much stricter environmental regulations, the company simply shifts its heavy polluting factories to another location, right? So basically, if we look at the aggregate impact of the company to our environment, the net effect may not be material, okay? So in the discussion that follows, Annette is gonna be talking about the regulatory issues related to ESG reporting, transparency, and validation of these data. And she will also talk about how one might be able to use to harvest the power of decentralized market to build smart contracts, to have distributed ledgers, to provide to provide better information and hopefully to help us to solve the climate crisis that we're currently facing.
Okay. Well, thanks so much, Lynn, and thanks for having me here today. This is really a pleasure on a topic that is of great interest to all of us. So Lynn has given you a great sort of overview of ESG and what it entails. And as she said, I'll go into a little bit more, a deeper dive on climate-related disclosure requirements, both those that have been adopted and those that are currently in the proposing stage globally. A number of major markets, including the UK, the EU, Hong Kong, Switzerland, New Zealand, and Brazil, have already adopted climate-related disclosures that are largely based on the work of an organization called the TCFD, which is the Task Force on Climate-Related Financial Disclosure. And the TCFD is the group that was created by the Financial Stability Board to develop recommendations on the types of climate-related information that companies should disclose. The TCFD has had a very impressive record and impact. It's been adopted as the global standard, as I said, in a number of the jurisdictions that do have climate-related disclosures. And in addition, international accounting standard setters are now also building global standards for climate risk disclosure on the basis of the TCFD recommendations. So what are those recommendations? At a very high level, the disclosure requirements break into 4 thematic areas that represent the core elements of how a company operates. So the disclosures relate to governance, strategy, risk management, and metrics and targets. And as you can imagine, based on those very high-level themes, the disclosures have to be more tailored. So they're trying to tailor them by industry because obviously a one-size-fits-all type of disclosure would not be particularly helpful or meaningful. In the UK, interestingly, again, because I think you've been sort of ahead of the pack, the climate-related disclosure requirements are in effect. And by next year, 1,300 of your largest companies and financial institutions are going to be required to publish detailed information on the impact of climate change on their businesses. So the U.S. SEC has been a little bit behind, and it's, I must say, more controversial in the U.S., shall we say. The SEC issued its climate disclosure proposal on March 21, and the public comment period was recently extended because a lot of people said they needed more time. The proposal, as I mentioned, has generated a lot of controversy, unfortunately, because folks are arguing that the scope is too vast. As is unfortunately often the case, the SEC did not just adopt the TCFD standards, but wanted to go one better. And so that is making the chance for a unified global proposal unachievable at this point, I think. In the US, some are really looking at this and saying that it really is a turning point with respect to corporate disclosure for US companies, because this goes well beyond the kind of financial disclosure that we're used to seeing there. But also, and I'll talk about this a little later, it sort of foretells further disclosure changes in other ESG areas of the type that Lynn mentioned that go beyond environmental, because it's E, S, and G, so the S and the G also may be on the horizon. At a high level, the U.S. proposal requires disclosure, as I said, of climate-related risks, also greenhouse gas emissions and climate-related financial metrics. And it's designed to require a more standardized framework for companies to communicate their assessment of their climate-related risks, as well as how they measure those risks. So again, this is intended to be much more helpful than the voluntary disclosure we see today, which sometimes, as you alluded to, Lynn, is a little more advertising than it is really hard data that folks can rely upon. This disclosure is going to go in all manner of reporting requirements. So it'll be in the periodic reports, like the annual reports and the quarterly reporting. It will also be in registration statements, and there'll be disclosures that even have to be made outside of the financial statements. Companies are going to have to describe the impact of climate-related risks on things like their strategy, their financial planning, their capital allocation, their business model, and their outlook for the future. They also have metrics on greenhouse gas emissions, and you'll have to provide that for all the fiscal years that your financial report covers, the fiscal years in the report. It covers Scope 1 and Scope 2 reporting, which we would all expect. Probably everybody here knows Scope 1 is a company's direct emissions, and Scope 2 is the emissions from a company's consumption of energy purchased by third parties. But the part that is generating the most controversy in the US is that it also requires Scope 3 emissions, which, as you probably know, is the most difficult to obtain, right? Because that really is this going beyond, it's going to a company's supply chain. So how do you, if you have a public obligation under SEC rules to disclose Scope 3 emissions, you have to be able to get that data. And it's not that easy, particularly today. The SEC is providing some sort of safe harbor. There were suggestions that they should have perhaps made it information that was furnished but not filed with the Commission, so you wouldn't have SEC liability on it. But the SEC decided to take a somewhat tougher stance there. So, and most large issuers would be required to disclose their Scope 3, or smaller issuers, believe it or not, if they had been referring to their Scope 3 emissions or targets on Scope 3 in the past. So it was sort of like no good deed went unpunished. If you had affirmatively tried to address those issues in your prior filings, now you're going to be required to continue that. So that is certainly challenging. Legal challenges to this in the U.S. are absolutely expected. I think the lawyers are already drawing up the litigation papers. They can't file anything until it's adopted, so it wouldn't be ripe for a court to decide. But it is unfortunate because that could potentially slow things down. As you may know, in the U.S., for the SEC to have authority to do this, they have to show that this is material to an investor's decision, and that it's necessary and appropriate in the public interest. That's the legal standard. And the test is also whether a reasonable investor would find this kind of disclosure necessary for investment or share voting purposes. Now, arguably, one would say, and I learned this from certainly the wonderful presentations we had at the Judge School with some of our students there, with all the ESG investing, it's certainly given what we are seeing about investors' interest in these kinds of products, one could argue that it is material to a lot of investors in terms of their investment decisions, but it's not the traditional way that investors looked at this. So that's going to be the debate. Chairman Gensler of the SEC, not surprisingly, argues that these disclosures are definitely relevant for investment decisions. He stated it pretty succinctly. He said, disclosure helps companies raise money. It helps the efficient allocation of capital across the market, and it helps investors place their money in the companies that fit their investing needs. So I think in very simple terms, he's written the SEC's brief in defense of their rulemaking. So many in the U.S. are looking at this and saying, well, this is the tip of the iceberg, because if the SEC is doing this with respect to the E, S and G can't be far behind. And I think that's probably right. And if you look at in the UK, I mean, the UK certainly has seen a broadening of disclosures as well. The UK Financial Conduct Authority on as recently as April 20th, announced new rules that require listed companies to report information and disclosure against targets on, for instance, the representation of women on boards and underrepresented ethnic minorities. And as I said, those are going into effect. Their target is 40% of women on boards and at least one woman in a sort of senior position and one member of an ethnic minority on a board. And again, it doesn't require that, but it's like disclose and explain if you haven't met the target. And this is a very interesting way of approaching it. In the US, we had exact the same approach. NASDAQ, one of our major markets, and also it's a self-regulatory organization, so it has listing standards that apply to its issuers. And they recently did a rulemaking that was approved by the SEC that had a similar requirement that NASDAQ companies have to disclose whether they have, I believe, 2 women on their boards and whether they have ethnic minorities also represented. Although interestingly, I think it was a day or 2 ago, the state of California in the US, which had been the leader in this area in requiring that they have increased representation on boards in California, and it wasn't a disclosure requirement, they were mandating it. That California requirement was overturned this week by a California court on the basis that it was inconsistent with California law and I think the California Constitution. So all that being said, I think it's very clear that the SEC and particularly Chair Gensler is very interested in proposing human capital disclosure, which is one of the things that Lynn focused on. That's the S in the social, so and in the S in ESG, and that proposal could be forthcoming very soon. He's been quoted as saying that the disclosure could cover a number of metrics, and these are very interesting. Metrics such as workforce turnover, skills and development training, compensation, benefits, workforce demographics, including diversity, and health and safety. And again, there is a real interest in seeing that type of disclosure. I wonder, again, how far they'll be able to go in mandating that. But those are the kinds of metrics today that there are groups that are trying to gather that data. I'm on the board of an organization called Just Capital that tries to gather that data and put together metrics. But again, you have to rely on what is voluntarily disclosed in order to put that together, so you could get very divergent results. So this is obviously a very important area and a focus for regulators, and was delighted to be able to share that with you and look forward to the rest of our conversation where we will connect this with DeFi and what that can bring to the table in terms of these important issues. Thanks.
Okay, great. After Lynn and Annette gave this wonderful coverage of ESG, I thought I will cover the other topic, mentioned in the theme, right? So DeFi. So these are actually, as you know, these are the two sort of most focused trends, new trends across the world, right? But so far, actually, you probably don't think they're related. so I should just set the stage to talk about DeFi. I think Roger promised that he will actually make a proposal, really to link the two, okay? So I'm sure many of you already noted that we are facing currently a crypto revolution, right? So this is a revolution powered by the use of blockchain technology, which is this very creative and wonderful innovation created by computer scientists to supposedly create trust outside existing legal and economic systems, right? So, currently, our business transactions rely on trust of government authority or business intermediaries, right? To complete the transaction, right? If I go out to buy something in a restaurant, to buy a meal, I pay money, so I use paper money. So you have to trust either the British government or American government which issue the currency, right? That's the trust, right? So the blockchain basically trying to build the trust by creating a system of decentralized validators to record the transactions on a blockchain. So the idea is that you may not need the money, but rather so you just need to keep track of everything on the computer network, right? To the extent that all your spending or your income are recorded, we know you have money and you want to transfer money out, you can do that, right? So that's sort of the spirit. And by name, sort of, without getting into too much detail, so the blockchain is sort of block plus chain, right? So the block is a highly encrypted list of entries related to business transactions, right? And the blocks are supposed to be chained together and distributed in the entire network to ensure the trustworthiness of the content of each block, right? And once sort of you can create this nice system actually without authority because everything rely on the network computers, fully decentralized. So you can, if you can trust all the record there, you can do a lot of wonderful things about it, right? Smart contract is one of the sort of the major applications. Basically, a smart contract is an intelligent contract of software that can use block information to execute business transactions contingent on certain things happened already, right? So, if you deliver your shipment to me, right? So once it's recorded on the blockchain, then, whoever have the money can make a sort of the delivery for money. so make the payment. So things like that, right? Okay. And, this now actually in the last few years, really there's a whole system out there, right, building on this. All of this, in some sense, started with blockchain, which is the first cryptocurrency created in 2008. So here's a chart of the price of blockchain, right, currently standing at about $30,000 each BTC, right, which is already half down from the peak last year. Which was above 60,000. I heard about the blockchain a while ago when it was still in 2000 from a student when I was teaching a course on financial derivatives. I thought this thing sounds like too crazy, right? But look now, it's over 30,000. And actually, the current market cap is about 735 billion US dollar, right? So, right? So which is amazingly high, right? Which is already half, from the peak last year, right? So it's almost a sort of $1 trillion worth of wealth sitting there with this invention. And because of this really kind of stimulated a huge amount of excitement across the world, right? A lot of things went into it, a lot of new ventures and all sorts of projects. I have to say, if you sit back, from outside, despite sort of the premise of fully decentralized, right? Mining of Bitcoin, which is essential to accomplish this protocol, the recording of the record on the chain being fair and reliable. The mining actually is heavily concentrated. And of course, the blockchain is supposed to be a payment system, right? But if you look at the price, if you really use this, you will get a heart attack once from time to time, right? So the price can double, then drop in half in a few days. So I think sort of so far only a small fraction of Bitcoin trading is related to supposed purpose, right? So, but nevertheless, I think sort of I quote someone here: the beauty of the bull market is that it attracts the crazies. It also attracts money and attracts smart people in the world, right? Really to explore this technology. And I think sort of wonderful things will come out of this, right? So now there's literally a whole world, right? Crypto world there, right? So it has its own currencies, actually thousands of different cryptocurrencies out there, right? It has its own digital assets, and it has its own trading exchange, and it has its own so-called DAOs, right? So decentralized autonomous organizations out there doing all different things. I probably don't have time to get into all of this. So let me just quickly mention a few. Bitcoin price too volatile. People in this domain have been trying to design better currencies so that it will be more stable, the so-called stable coin, right? Basically, these are cryptocurrencies with the price pegged to other things like other cryptocurrency or fiat money or exchange traded commodity like gold, right? So metals. So fiat-based, there's sort of one of them here, Tether. So this is back to dollar, which is probably the most valuable at now, over 80 billion worth of cap there. And some of you probably know that the so-called Terra, it was crashed 2 weeks ago, right? So the currently actually is almost down to zero now. So it's not really backed by paper money or by metal, but rather actually backed by a creative algorithm supposed to adjust its supply dynamically over time to make sure its value stay constant, right? I guess sort of with this crash, this might be end of algorithm-based stablecoin. But nevertheless, you can see sort of here, Tether, suffered a bit of shock, but it's stabilized. So the other actually was not sort of moved much. But nevertheless, sort of there are certain issues here. The fiat-based sometimes there has been doubt about how much is really backed in the reserve, right? But these are the issues for another day. I should mention that using smart contracts and blockchains, sort of. People have been trying to design sort of better organizations, fully decentralized, autonomous organizations that can overcome concerns we have about, say, digital platforms, right? So, there have been a lot of concern about these large digital platforms like Facebook, right? So basically the conflict between platforms and users are going to become more and more important over time. So the idea here is that if you can record everything on blockchain, if you can trust these algorithms, maybe so you can let the algorithm run the platform, so that especially by delegates the control eventually back to users. Maybe you don't need to worry about users being exploited, right? But of course, there are fundamental issue here. They're very fundamental. Issue there. Actually, I worked a bit myself on this kind of issue. I have a recent paper coming out of Journal of Finance trying to dig this certain conflict, right? To really fully decentralize, you should make sure not too much profit incentive. If there's too much profit incentive, like Bitcoin, right? Mining is very profitable, right? So people across the world that really hire all these supercomputer or the mining machines to mine the coin, right? So they want to make money, right? Once you have that kind of incentive, we see mining pool, right? So basically, profit motive, once it's there, it's very hard to accomplish real decentralization. But on the other hand, without the profit incentive, who would build up this wonderful platform, right? So there's a conflict here. That conflict is very hard to get around, basically. I'm not going to get into detail there, but maybe in the discussion we can come back to this. some of you probably heard of NFTs, right? This is really the coolest thing at the moment, right? So basically, NFT is like a digital asset, right? So you could have a painting, and you can put it on the blockchain, and you can be assigned a unique ownership to the artwork, right? So here's one I took from OpenSea. So this is a very popular series called the CryptoPunk. So this piece was sold 9 months ago at the price of about 2,000 Ether. Which is about $4 million, right? So clearly, sort of, it has a very unique artistic style, but I think sort of, the valuation in this world is not necessarily just about artistic, right? But also about sort of being rare and being unique, right? So having a blue and red eye, so this is very unique in that domain. And then many of out there, sort of, currently the market cap of all this kind of NFTs is already over 150 billion US dollar, right? Which is, as I said, there's a word out there. And, NFT provide a certificate, right? A digital certificate as a proof of ownership, but it also creates, all sorts of issue, right? So it's not really sort of the ownership, right? So it's not the ownership recognized by any existing jurisdiction, but rather sort of recognized by blockchain, basically, right? So sometimes people compare this to bubble or Ponzi scheme, but nevertheless, I think sort of how do you establish ownership on the digital world? I think sort of this has been fascinating. Now, so this is my last page. I want to get into ESG, right? So both Lin and Annette pointed out a key issue about ESG is about disclosure, is about data. So ESG ratings clearly require, authentic data, reliable data, right? So how do you make sure consistency and transparencies, right? So this is definitely crucial for accomplishing ESG, right? And also this requires global coordination among firms and agencies in different countries. And also align the incentives among stakeholders, which can include firms, investors, rating agencies, without necessarily having authority, right? So, once we're talking about things across country, right? So there's no authority here. I'm not sure sort of everyone across the world by, any regulation from, not say, and I mentioned US doesn't have really a rule on this yet. Even if it does, I'm not sure many countries will want to obey. So then sort of, this has to be accomplished through some kind of incentive, right? Hopefully aligned, among all these different stakeholders. This is definitely a tremendous challenge, right? Right. So here I want to mention, I'm not sure blockchain is the solution, but the blockchain clearly offers many useful features, right? It's supposed to be, a system that can establish trust without necessarily having no authority. In fact, actually, it doesn't want to have an authority. That's the point, right? So of course, many are still trying to make it sort of more workable, really to solve some real problem. But I think sort of it does offer this premise, right? Maybe one could use blockchain to build trust and coordination, among all related stakeholders here. And also I should mention, really to solve the global environmental issue, right? Ultimately, it requires building trust among governments of different countries, which can be even harder, I can imagine, right? So can blockchain be used really to accomplish all this? I really leave Roger to solve this.
Well, so one of the great things here is you can immediately judge your friends by the way they set you up for the work you're going to do. And so I'm not going to solve it. I'm actually going to try to put this in a broader context. So I should also just add to my introduction, in addition to other things you heard, I'm also the Pembroke visiting professor in international finance at the Judge School. I see some friends and students here, and I think my colleagues at Pembroke would want me to mention that as well. So let me try to wrap up by thinking about this. And those who've worked with me before know I think about things in terms of economic history and what's gone before, because I actually believe that there are very few new problems in the world. I think they're just new technologies with pre-existing problems. So what's the problem that we're trying to solve here? We're trying to solve a problem about information. There's a lot of economic history and theory of information. There are two kinds of information problems that we're dealing with here. There's the information problem in the ESG world. So, I'm on the board of several companies. They all claim to be, good, solid citizens in ESG. How do we know that's true? Lynn raised this question of so-called greenwashing. She also raised the question of the other side, which is there are investors who value information around ESG characteristics. So Lynn talked already about the UN Principles for Responsible Investing. One of the signatories was actually me personally when I was the CEO of TIA. We were one of the first. And they have literally now $1.4 trillion that is screened through an ESG screen. So we have a fundamental problem here, which is both parties value information. And one of the things that one of the great economists taught us about information, or that Friedrich Hayek taught us, is that information is of value for a reason that Annette pointed out, which is that, and Gary Gensler said it in sort of more practical terms, information is valuable because it allows people to achieve whatever their longer term goals will be. So you get benefit by having more versus less information. So what we're struggling with here is the characteristics of information. And what are the characteristics of information? There are 3 or 4 of them that are relevant. One of them is that you may know information about yourself that others don't. And companies know information about their ESG footprint, maybe that you don't. And that is one of the major challenges of information, which is there's something called information asymmetry. So I know things about myself that my doctor doesn't know, and that doesn't my wife, and that doesn't know. You know things about yourself that others don't know. So we have this fundamental problem of information asymmetry. And that leads to a couple of big challenges. One is you can get what is called a market for lemons, which is people sell something that looks like a good product when it's actually a lemon. So anyone who's ever bought a used car knows that you're confronting this problem. Someone says, this car is worth, $150,000, this used car. Why is that? Well, because it's a classic and somebody else looks at it and says it's worth $12,000 US. And there's a lot of information asymmetry. So what we're trying to overcome here with these regulations and with this disclosure is this question of information asymmetry. The other problem that we have here is there's a moral hazard. So a moral hazard is basically, I want to make you believe something that's true about me. I may change my behavior once you buy my stock. So you buy my stock as an ESG company, and then perhaps over time I drift away from that challenge or from being very good about ESG. And so how do we overcome this? There are a number of answers to these kinds of information asymmetry problems, to the history of information economics that basically this set of problems has worked with. Lynn put her finger on some of it. One of the ways that we have traditionally dealt with information asymmetry, with these problems of knowledge or actions of knowledge, is to have a third party do a validation. Third-party validation, however, depends on standards. So we start with the accounting world, where in the US we have GAAP, then we also have something called statutory accounting, then there's IFRS, so there are different kinds of standards. But then you get accounting firms that come in and say, those statements, financial statements, have been prepared in a way that's consistent with GAAP. They are, they fairly represent the underlying financial matters. So the point that Lynn was making so clearly is that the information around ESG is not yet fully developed. And so you end up having the challenge that she pointed out, which is, those that are supposed to be evaluating end up with very different perspectives. Not so much true in bonds or other things, though I would say, and we all agree, that the great financial crisis being driven by mortgage-backed securities also shows that we have the same problem in other kinds of financial assets. So that then takes us to Annette. Annette brings the perspective of the regulators. So what's the perspective of the regulators? Two things. One is they really believe strongly in disclosure. All right? Now the theory of disclosure is if we put it out there, truth will eventually emerge. There was a famous case by one of the great US Supreme Court justices, Brandeis, who basically said, the sunshine is the best disinfectant. Put more information out there and the truth will eventually emerge. And that's what disclosure is all about. We also have, as Annette points out, a regulatory regime, which is to say there are government-driven standard setters. So Lynn was talking about private standard setters, Annette's talking about government-driven standard setters. The challenge for both of those is that they don't really resolve the information asymmetry problem. They just simply throw more information out there. So that then takes me to Way's great point, which is maybe the solution to all of this is this thing called DeFi. Now, what is DeFi? He gave some examples, but what it really is this notion of completely decentralized finance. It is to say that we don't need an intermediary in the world of finance, or we don't need an intermediary in the world of deciding good ESG, that there will be a crowdsourcing of information that allows better outcomes. Now, the theory of DeFi is you disclose everything about yourself. I now want a loan, I have this income, I have these assets. And instead of going through an intermediary, a bank, you go directly to individuals who are willing to lend based on those facts. Now, if you've been following, you know that that's a pretty flawed problem because people will disclose false information about themselves. They'll hide information. Moral hazard will become a problem. Incomplete information will become a problem. Information asymmetries will become a problem. So I think the biggest challenge for this notion of DeFi driving the ESG answer is that it really doesn't overcome this information challenge. So the proposal, and one last point I would make, is there's a great deal of knowledge around how bad information tends to drive out good information. Now, why is that the case? That's the case because it is very costly to do the research to get accurate information. So one of the ironic things about information is it's free in some ways, but good information is actually quite costly. And that circles back to where Lynn was. So to get to the baseline point of, well, gee, is this company really good in ESG and should I invest in it? One has to do a huge amount of research to sort out level 1, level 2, and ultimately level 3. And so here's our challenge, which is good information is very, very costly. Bad information tends to drive out good information, just as bad money tends to drive out good money. So to the proposal. The proposal is that we learn from the past. We recognize that ESG information is like every other information. It is subject to all these failures. There's a failure of incomplete information. There's a failure of asymmetric information, moral hazard, all of these challenges. And instead of saying that going to DeFi is the only answer, my proposal is that we continue to build off of the historic systems that we've had that are represented by these three individuals, which is we certainly have to have regulation. We need to have standard setters. We need to have third-party validators, which is we put more and more weight on auditors, for example. There will be ESG auditors, I propose, as a new class of auditors. And I would suggest to some of our students here, if you want to figure out a way to make a lot of money going forward, become an ESG auditor. And then go into the government, become an ESG standard setter. And at the same time, we leverage Way's notions, which is we also try to crowdsource as much information as we possibly can. The final point, however, that we've learned about crowdsourcing information is we still need, I believe, to have a third-party validator of information, because we've seen through his charts with things such as Bitcoin going up and down in value, that this crowdsourcing of information doesn't necessarily lead to a stable outcome. So I hate to say it, but I think there's no new news under the sun. What we've done with accounting information, what we've done with health information, is I think what we're going to do with ESG information, which is have a multi-tiered solution that will include government standard setters, regulators, private party validators, and then also this new thing, which is a collective gathering up of information, but with some controls on the quality of that information. So that is the wrap-up summation. It was all on this one little piece of paper. And I tried to leverage across all the great wisdom of my colleagues here. And with that, we open it up to questions, comments, challenges. And remember, the theme here is whether or not DeFi would be the answer to the ESG. And I've said, no, I don't think it is. And I'm completely open to having people challenge why I may be wrong on that. So with that, let me stop. And I guess our moderator will coordinate Q&A. So thank you very much.
So we're taking questions from the floor. Is there a microphone? Yes? Okay, so start over here.
Hello, I'm going to be brave and ask the first question. I'm Anil Madhavapedi from the Computer Laboratory. It was a fascinating set of balances that you all struck there. From a technology perspective, I just wanted to observe that blockchain can be split into two separate halves. The first one is that it's a distributed ledger that can record information. And the second one is essentially deregulated finance. So anyone can do whatever they want. And it strikes me that there is a balance in the technology from the wrap-up that Roger gave, that you could use the good bits of the lower-level ledger to build the series of hierarchical, well-regulated systems, and then leave the unregulated markets for the Wild West, and state that ESG is too important a problem to be left to a bunch of crypto punks, or whatever the term is. So do you think that this is where our research and our intellectual efforts should be focused, on the intersection of technology and regulation towards solving the outcome at hand of ESG?
Well, obviously I do. I think unregulated distribution of information does not necessarily lead to better information. Right, I do believe bad information can drive out good because it's costly to get good information. Having said that, the knowledge around ESG impact is broadly distributed. And so the ability to sort of gather up all that information but then validate the accurate one, I think, would be very helpful. And when that technology would be a good, useful way to be able to distinguish good from bad, gather good versus bad, I think is a place where we really should explore. But at the end of the day, we have to solve this information problem and figure out if new technology solves the problem of lousy information versus good information, greenwashing, moral hazard, all those sorts of things, which is really the nature of the problem, I think.
I would say from my perspective, certainly as a former securities regulator, I look at it the way you do. And I say, well, you've got all this speculative trading. I mean, Wei showed us all these coins. And I said, well, this is crazy. These are, as you know, the SEC says these are securities. They're investment contracts. People are investing in these products to make money, and they're really not that different from securities and should be regulated as such. On the other hand, when you look at distributed ledger technology, to me there's so much that could be of value there. I mean, we've talked about even in the carbon markets, the validation of carbon projects where you could have use the distributed ledger to ensure that projects are being managed the way they're supposed to be, or that the soil content is the way it should be, and that this would all be on a blockchain that is immutable and that everyone would have access to. And so it could actually bring much greater confidence in that market if that kind of information were crowdsourced in a credible way. So it just seems to me that what's happened is we took this technology and we had, for lack of a better term, a bunch of kids who had fun with it and just made huge amounts of money. But then there were like the adults in the room who could really use this in ways that would intersect with regulated markets. I also think we're talking in the carbon space about even using the blockchain for like meta registries for carbon credit transactions that are done, and you could potentially, it goes to something you showed on your slide, if you had buy-in from governments, you could even link it to like the UN requirements that everyone could see what's being done in various jurisdictions on a voluntary basis versus the compliance basis. I mean, there's just a lot of potential for the distributed ledger and the blockchain that I don't think we've realized yet, because we're still sort of in the gaming stage, I think, personally.
Yeah. If I can also just add to what Annette's saying, I very much want to echo on Anil and Annette's point. So I believe that some kind of hybrid system could be ideal, because I mean these technologies are so powerful, right? So as Annette was mentioning, one of the challenges to capture a firm's scope 3 carbon carbon emission is indeed this, how to trace the carbon footprints along the supply chain is very tricky, right? So if we can use the distributed ledger system, have crowdsourced information gathering, that could be a very powerful way to have more transparency and achieve better information and efficiency. Obviously, networks also have problems because we can, as Roger was mentioning, there could be bad information. Network can indeed transmit or even amplify bad information information. There could also be a free riding problem, right? So if you see other people are inputting information into the system, that reduces your incentive to acquire information. But I think these are the problems that we're aware of, and so again, right, some kind of hybrid system of harvesting the power of technology with validation, with standard setting can help us, utilize this technology. So I think decentralized finance, a lot of buzzwords are about this kind of crazy Luna, about this kind of Bitcoin speculation, but I think the underlying technology could be actually quite a useful resource for the society.
Can I add one? So I think I want to echo that Anil mentioned. So I think a key thing is really about, do we need one authority or fully decentralization? So it seems like these are two polar cases, right? But maybe the best is somewhere in the middle, right? We don't really need to be fully decentralized, burn all this electricity just for the sake of being fully decentralized, right? But, of course, have one authority sometimes can be troubling, right? You worry, right? So, can you trust one guy with everything? Of course, no. So I think to have multiple authority, I mean, in the ESG domain, different governments are clearly have to be involved, but they have different stakes and different perspective, right? We just do the simple reporting, the company involved, there are auditors involved, there are all these rating agency involved. So I think sort of perhaps everyone should have some degree of authority, right? So, so to have sort of shared authority, I think it can be already a lot more efficient or effective than current system, and also, can also be reasonably efficient. We don't have to burn all this electricities. But at the same time, I think sort of, often, right, so once you do that, end up you creating another set of authorities anyway. I think sort of just exploring, taking advantage of existing stakeholders by giving them sort of the right, authorization on the blockchain, I think it can already do a lot. So I think sort of that really different ways to use the technology, which is wonderful. But the trouble is that I am worried about the sort of I think Roger already mentioned to be obsessed about being decentralization per se. I think so that's sort of the issue I think in my mind.
Yeah, thank you. I really enjoyed the talk. Thank you. And you're getting at obviously some very important issues. I want to step away from the technology in its pure sense and actually talk more about governance of the technology systems. Because when we talk about centralization versus decentralization, it's really that spectrum in terms of governance, particularly consensus mechanisms, by which mechanism do we use to make decisions about what's actually recorded on the blockchain. And Roger, you made a great point, like really, good information is expensive. And it's kind of the point of Bitcoin, right? I mean, you have to pay to play. And the more valuable it is, the more you have to pay through a combination of investment in the mining machines, but also in the amount of energy I have to use to actually solve the cryptographic puzzle, to win the award for, register, right? So the point is to waste energy. The point is to actually make it expensive. Because that's what is linked to high quality information, because I'm going to make sure I'm validating blocks that are unlikely to be forked or I've lost my investment. And that's what's interesting to me about this fully decentralized model. We could leave issues about whether trust is ascending or descending with respect to a lot of the institutions we've historically trusted that give rise to these sorts of decentralized movements. We can leave that to another sort of bucket, right? But I'm more interested in this sort of the incentives around why the blockchain, and with expanding network effects, right? Which then feeds into the value, which then feeds into the price, which then feeds into the cost, which feeds into, in theory, the quality of the information, right? It gets this virtuous circle. Could you comment?
No, so I think, yes, I agree with the point you made. And I think the base point here is high quality information is very, very expensive to create, to validate, to keep standardized. And one of the challenges that we have in a completely decentralized world, I believe, and I'm more skeptical than others, is there's a replication of bad information as well. And in the decentralized world on a blockchain, if bad information gets built in, it is very, very difficult and almost impossible to take it out. And so you have both of these dilemmas, which is, bad information stays and gets replicated. To your point, good information becomes more and more expensive to create, which is why I believe, to Wei's point, a hybrid is appropriate. Because at the end of the day, what we're really talking about here is the pure, again, back to information economics. The thing that's fascinating about all of this is that good information is also a pure public good, right? Having good, honest information about high quality versus low quality ESG makes everyone better off. And so the challenge is, how do you get that information out there, get private players to do it, and I think part of the answer is with other things to get the government to do it. We can't, I worry about keeping this purely private for the reason you point out. You get this arms race of more and more expensive activity, and then you're burning huge amounts of resources for something that's actually at the margin not very valuable, right? Knowing how good or bad ExxonMobil is, or how good or bad a particular carbon offset is probably not worth the money that the private sector would pay for it. And I think that's a little bit of the dilemma that we're confronting. And your example of blockchain is exactly that. The amount of money that gets burned to get one extra coin, given how the value of the coin fluctuates, is probably not a good societal trade-off, is the way I think about it, Rob. So,
yeah, only one follow-on comment. Japanese Fukushima disaster, 2011. That's an ESG impacting event, certainly in the environment.
Right.
Few people in Tokyo believe the radiation data being reported by the Japanese government.
Right.
Wow.
But
Garbage in, if it goes on the blockchain, it's still garbage.
it's still garbage.
Wow.
And you undercut, you undercut trust, right? And it goes to Wei's really good point. At the end of the day, all this question about information is information that you trust. And it has to come from a trusted authority. And there's a theory, the theory of DeFi is there's no trusted authority, but you trust crowdsourcing. But there's so much evidence that proves that that also isn't true. And so I think we are going to have to ultimately settle on some sort of middle ground. The only other thing we haven't talked about, and I never would have a point of view about this, is we have to have complete markets. So just as you can short a company if you don't believe their financial statements, we have to have the ability to short the stock of a company if you don't believe their ESG statements. And then you get into a really dynamic situation, which I think may be net positive, because the ability to short forces companies to be much more accurate, I believe. And so I think we want to create really complete markets around this. And another place to look, if I were an MFin student, is creating options on ESG accuracy. Because I actually think over time there'll be a lot of money to be made in shorting as well as going long companies based on your perspective, their ESG accuracy.
I want to one thing to Bob about the whether this electricity is really necessary to solve the hardest puzzle. I think the new trend, there's many of these crypto networks now moving toward the proof of stake, right? So it's an alternative which will avoid doing all this hard computation. But of course, that solution is not ideal. I mean, it creates another sort of problem, right? Because there's incentive for someone to, just to concentrate the stake. So of course, it's not a perfect solution. That's why all this has a trade-off. So I think the computer scientists are working hard to trying to come up with alternatives to this. I mean, maybe we will see a better solution at some point, I think. But again, any solution will have to confront all this trade-off, I think. Right, so we shouldn't expect the perfect solution down the road. So that's why I think maybe we shouldn't be so consumed by being fully decentralized. We are in a world that has to have some authority, but the question is how to manage it. So the different authority, right?
Yeah, thanks so much for the discussion. I'm De Quan, as the first-year PhD candidate at the Business Model Innovation Group at the Institute for Manufacturing. I would like to bring a more practical question about what is like the potential research question that you might be interesting for the look in the domain of blockchain and ESG, possibly with respect to the supply chain ESG. Thanks so much.
Right.
Way, I think it's-
I think sort of, on supply chain, I think sort of, there would be a lot of application for this. I think, which is already happening, I think.
Right.
Sort of, so I think that, again, if we are not insist on being permissionless, being public, so there's a new set of, permission-based blockchain there, right? Could be actually very helpful in solving sort of all these issues on supply chain, right? It could be sort of a chain set up among the related parties. This doesn't have to be broadcast to the world, right? So I think, there are lots of application on shipping, clearly, right? Once the ship goes off the harbor, this should be recorded on the chain, and one can easily follow sort of what's happening with the shipment, and at every step, the banks, the firms, they all know where the good is. If a good gets shipped, the bank should send the payment and all that. This can be automated, right? So.
Can follow up?
Okay.
I mean, there are so many papers there, and we look at them, but none of them, I think, is like published in the top journals, in my view.
Okay.
Just wondering, what is like if like doing the sort of the traceability improvement innovations, like how can it be published in a high quality journal? that is the thing. That is the thing. What burns me days by days. I don't figure
This
out.
is even more practical.
The things that get published in high-quality journals are the most theoretical and abstract. They have nothing to do with the real world.
Right.
Figure it out.
Right. I think sort of, there are journal for this kind of thing. So perhaps, I think sort of the technology clearly is creating a lot of new questions, new applications. I think, on this particular issue you raised, I think operations management. So this whole, supply chain finance out there. I think sort of scholars in that area must be, I know they're totally open and fascinated about it. So, and of course, sort of every area has its own kind of conceptual issues, right? So I think in finance, sort of, we haven't actually so kind of well, sort of, a lot of interest on crypto, returns, crypto speculations and all that. But I think on the supply chain, we haven't really reached out to that yet. But I think sort of, if this, if you can find a way to sort of, this is a way to relate to fundamental conceptual issues in finance, I think there should be, even the top journals should have a lot of interest for it.
Yeah, just to add a little bit more to that. So I think, the approach to write good papers is either, especially in this new domain of ESG and now linked with decentralized finance, is that either you have very unique data, right, that allows you to explore what people have not understood about the market, or you kind of take, for example, the concepts that's proposed in our discussion, right? Roger's been talking about information economics, information asymmetry, right? So there's the problems about standard setting, right? How do you address this problem, right? So Annette has been talking about transparency, right? So you can try to kind of build a theoretical framework that come up with a proposal, right? So how do you design a decentralized market for information collection and accounting for these information problems we have, and try to find to propose regulatory solutions or policy recommendations about how to structure such markets. I think that would be quite valuable.
Yeah, I agree with you on that. I think the point of my discussion, so to speak, is we have a lot of theoretical and then applied information and Nobel Prizes in economics that have been won around this whole question of information challenges. So Akerlof, Stiglitz, Mike Spence, Oliver Hart who's done work on incomplete contracts. There's a lot of theory in this world of information asymmetries, incomplete contracts, the theory of the firm. How do you apply all of that to this new area of information, which is ESG, and the flip side, which is the investment process around using this information? So I think there's a great deal of both theoretical and applied work to be done.
You've written the outline.
Well, yes, but he's ahead of me in terms of getting it on paper. But I do think this is the reason I did my little contributions. I think this fits into this whole space of information work that's been done for the last 20 or 30 years. There's more to do.
So Roger basically saying if you can come up with a more concrete solutions, clearly everybody would be excited.
Right. But I think people would be excited because we keep running into this problem in the world of finance. So we had it in these small examples like selling used cars, but the whole great financial crisis around mortgage-backed securities was exactly this problem. Individuals not disclosing fully their financial state, regulators not being able to fully understand what was going on, and then finally rating agencies giving AAA ratings to stuff that proved to be BB minus credit. It was just yet another example of information asymmetry and weakness, and with huge impacts in the global economy. So it's not to be taken lightly.
You know, as a regulator, I can tell you when we went to examine some of the major Wall Street firms who were having trouble with their mortgage-backed portfolios, and we asked them how they were valuing the portfolios, they had not even retained the information on what the underlyings were. There was only one firm, I won't say which one, that really had the data and could look at the underlying mortgages and assess based on what they were seeing what was really happening. Most of them they just completely delegated to the rating agencies, and the rating agencies were using models that were not
That's
worth
actually
anything.
here, blockchain can really help solving that problem,
Yes.
right? Why shouldn't, hidden in a fire and nobody can see? Now, if you put this on blockchain,
That's
everybody
right.
can see
And it could
it.
be
And
dynamic.
if
But-
somebody can want to devote the energy to, dive into sort of the composition of all these
That's a very
individual
good-
I
loans
think
in the
that's
pool, now actually it's possible, right? So
Yeah.
if one
It is,
really
but-
move all this onto blockchain.
Yeah, but
Yeah.
you still need the analytical skill. Yes.
Well, once you put there,
get the
somebody
data's
can
out
do
there,
it.
but then you need the analytical
Yeah, yeah.
skills which goes back to how expensive it is to do that. We have a question.
Thanks a lot. So my name is Dmitry Vasiliev. I work at the International Monetary Fund, but here on secondment with the Cambridge Center for Alternative Finance.
Oh, good.
So it was super interesting. Thanks a lot. I have more like a comment, and I would like to hear what you think about this. So the pandemic showed that the governments have a lot of power over societies, but at the same time, they still cannot persuade them to get vaccinated. So it's kind of a very nice sign of what will happen when we get serious about climate change. It will be very hard to build consensus about what we have to do. And the word decentralized, kind of in this decentralized finance, is very important because it can be also very empowering. Because people or small enterprises, or large, small, or just individuals, they can create what they want, and everyone in the world can kind of access this service, right? So, for example, if I want to grow a tree to offset Vivek's carbon emission, and Vivek wants to finance this operation, it will be very easy in decentralized finance world, right? And but it's true. What I can do, I can probably issue this NFT, and Vivek can just buy this NFT. So the operation is very simple, but the information part is still a problem. Right. So what? But I guess one solution can be that I can disclose all information about my activity on blockchain, and it will be there. But then some other part, like the government, should kind of verify that there is this connection between issued NFT and real activity.
Right.
So that's probably one of the role of the government. We talked about, and you gave this overview how complex it is to create this ESG regulation, how there are so many risks, litigation risks around this, because the government is trying from the top regulate everything, the whole market. But here, the government can kind of establish this connection between NFT and real activity. So kind of maybe it's costlier, but it's kind of less prone to risks of litigation.
Well, you've made the case for really what is the current regulatory structure, right? I mean, what what we have today is the government doesn't create these products, the government doesn't create securities, right? But it regulates the intermediaries. So, I mean, one of the things that I think about when we talk about DeFi is, I mean, it sounds so wonderful, you know, we'll all be buying from each other without going through an intermediary. Well, how are you going to find each other? There's a reason why we have markets, because markets bring buyers and sellers together, and the more of them you bring together, the more efficient pricing you have. So the role of government is to ensure that the market has integrity. It regulates the market as an intermediary. It regulates those who act as go-betweens, right? The brokers and the dealers. It regulates their activities and also ensures, you know, it looks to things like customer protection, right? The integrity of the information and customer protection. Part of what this new technology is doing is it's challenging those traditional notions, which frankly have grown up because they work so effectively. Right. And so I think the big problem that regulators have now is they look at this and it's very threatening to the entire regulatory regime. Even if you look at the stable coins and what's happened. I mean, we saw a President's Working Group report, you know, not that long before we had this recent, you know, disaster where the Treasury Department and other financial regulators in the U.S. were saying this really needs some oversight. I mean, you can't tell if this stuff is actually backed, what it's backed by. If these players have integrity, what are they selling? And sure enough, the only good news with this particular crisis was that it really wasn't systemic. Mm-hmm. But the problem is if these things do become big enough to cause other systemic risks, it again, you know, calls the question of what kind of regulation do we need over this? And so, you know, again, the technology is forcing us to think about those issues, but I think there are ways to use the technology consistent with those frameworks, or maybe the frameworks have to change a little bit, but I don't think they can go by the wayside.
I will follow up on what you mentioned about this idea that, you know, maybe sort of one can set up a platform, somebody, you know, you pay some money, somebody else can grow a tree somewhere else, right? In fact, I believe actually this has been done. There's some effort doing that. So in China, I know there's a platform called the AliForest or something. So basically it's kind of this idea. You know, it's a charity kind of platform. If you donate some money, so that, you know, so that the platform will make sure somebody else in the western part of China sort of they can grow a tree. And then of course I think sort of this is sort of one platform like you know, do you know it's a real tree? Who knows, right? How do you make sure somebody need to verify it?
But then you should talk about what you're doing in terms of why your whole
well, that's why I care
Integrity
about
Council
it, because
standing
I'm, you know, the chair of this new international organization called the Integrity Council of the Voluntary Carbon Markets. And, you know, we talked about greenwashing. We talked about the fact that there are no sort of standards on what is an offset, you know, how much, you know, greenhouse gas emissions should be represented by a particular contract. And so our first goal is to come up with standards, like, you know, commonly understood standards on what a truly high integrity liquid carbon offset would mean. And then from there, I think if you have that, then you'll see a real scale in the markets. I mean, you'll see a lot more trading, because I think there's a lot of interest in trading in those kinds of things today. I think there is, as you said, a lot of interest on the part of individuals and corporations to do what they can in, you know, on carbon reduction, but they don't have any confidence in the markets. You don't know. It's the Wild West. You don't know.
But that's why actually having a blockchain can help. If you can set it up well, make sure sort of the information input onto the chain is reliable, then, you know, right? So I'm sure many people will be willing to give money.
And if it's very transparent, others can look and say that actually doesn't meet the standards.
Right. Well. So
but but you need a party to set the standards.
You need somebody to set the standards.
And
again,
that's back to this hybrid world.
Exactly.
Yep.
So my name's Duncan Needham. I'm an economic historian, so I had a little moment over here when you mentioned how important economic history was.
It's all economic.
So, we know from our psychologist friends that we hear what we want to hear, and I heard three words, essentially: trust, profits, and authority. And when I think about money, thinking about money without authority just makes no sense to me whatsoever, because money has to have the authority of the state, and that's what the financial revolution is all about, marrying the authority of the state with the Bank of England, etc. And as I was thinking about those three words, I was thinking, my question is going to be, how aware is ESG of its own historical taproots? Because what's behind my question is, when I think about those three words, I think about, particularly in the UK, the mutual movement, whether it's the trustee savings banks, whether it's building societies, whether it's mutual insurance companies, because all of those are non-profit organizations. The trust comes from trust in one's own members, but standing behind it, is always the authority of the state. The trustee savings bank invests in government bonds, the state. Building societies are backed ultimately by the state. And I can't get away from this idea that authority has to be there. And this idea of decentralized authority, it literally makes no sense to me at all. And that's why I will never invest in cryptocurrency. And as my old boss, Jamie Dimon, said, if any of his employees invested in it, he'd fire them straight away. And I agree with him. But anyway, that's my question. How aware is the SG movement of its own historical taproots in ethical investing in previous times?
Yeah, so I would say that this, as I mentioned, so this ESG investment movement, it does certainly has its historical roots, and on terms of the G dimension, like after the tech bubble of 2000, right? So there's a huge, we have all these accounting scandals, right? So like Enron, WorldCom, right? So these companies falsify their financial records, and one of the, so triggered by the scandal, there's been major regulatory reforms, and one of the things is to reform the kind of the incentive structure, right? So we need to hold the managers more, the CEOs more accountable, right? So that's kind of fits into the governance pillar, which is, how should the company be run, right? So, what kind of incentives we want to mitigate the short-term incentives of the managers and, shift their focus more towards the kind of the long-term incentive, which again bridges into, what these kind of sustainable investment movement, which is we're trying to, hold the company accountable for and focus more on the long-term shareholder welfare. So, yeah. But the kind of the climate, the climate focus, I would say, is kind of a more recent thing. Yeah.
Right.
Yeah, just building something, Roger, you were talking about earlier. So, one of the things you mentioned was Stiglitz, and the classic paper is Grossman and Stiglitz, right? The impossibility of efficient markets. So, one of the problems is the information, the ESG information, is not actually owned by anybody. That's the whole idea here.
Right.
But if you give the informational range to somebody, right? So whether it's a private blockchain or proof of stake or whatever, that person has an incentive in maintaining the system.
Right.
So you can think of government's role sort of like, okay, we'll have an auction. So we have one person who gets the idea of setting standards for the ESG industry, but it's recorded in the blockchain. So if anybody else finds a mistake or more than 10% of the mistakes in that, you lose your license and it goes to someone else.
Right.
So the government doesn't really have to intervene very much because all it does is the winner of the auction. The auction itself raises money for the taxpayers. And from the company's point of view, the one which has actually got the rents, they have huge incentives because the moment you set a standard, you got all the investment firms coming in, everybody's trying to invest according to ESG standards, and this is sort of sanctioned by the government. Right? So it's sort of a halfway house, not decentralized, but it's a way of recording what the ESG is and making sure that it really works.
Mm-hmm. Right. So I agree with that. And you've taken us to another field in economics I think is relevant here, which is, what's it called, institution design.
Exactly. The auctions here in middle ground.
Right. And so I think part of the challenge here that we're working with is the institution design question, right? And so Eric Maskin, Hurwicz, and Roger Myerson won an award around this topic. And I think what we're struggling with is exactly that. So how do we create institution design that incentivize honest disclosure and leveraging this broad technology in a world that still has authority, because I agree with you, there's no such thing as decentralized authority. And that's exactly the challenge, is creating the institutional incentives to get accurate information out there in a way that's not as costly as the world that exists right now. And so I think you're taking us into another opportunity for a PhD paper.
Yes, absolutely. There
Somebody's
is your
taking this
dissertation
down.
outline.
There are all these dissertation topics that are coming out of this.
Wonderful.
Yeah.
Well, anyway,
It's great.
yeah. I think we
Good. We
no,
got
we
one.
haven't exhausted.
We got another one.
We've exhausted the panel, haven't
have
exhausted the audience.
Yeah, we have another question.
Thank you very much for your talk. My name is Noah. I'm a public health student
good.
here. And I'm just wondering what you think the scope for responsible investment in blockchain is, both in the private sector and as tools for government policy to address some of the negative public health externalities of corporations, particularly for nutrition and linking into
Right.
sustainable food production.
Yeah.
And then a second build-up question. Do you think that this has potential to increase accountability for global health governance and climate governance?
Very
It's
interesting.
interesting. Yeah, this is.
I like it.
Well, there's some MFin students here who put up yesterday or
Yeah,
2 days ago
Thursday.
this long list
Monday.
of the taxonomy of ESG that emerged. That is, I forget, one of the professors at the Judge is doing this. And one of them, I think, had to do with this question of global health,
Yeah.
right? Because I think it's going to fall under the S. It may fall under the E, right? Poor E behavior
Yes, yeah.
ends up having poor health outcomes. The S behavior clearly, I think, touches this. So I think this is one of those subsets of the very large number of things that's going to fall under ESG over at some point. You raise another word that's really important here, which is externalities,
Yeah.
right? And that's something else that we've sort of been talking about in explicitly or implicitly here, because poor behaviors spills over not just to the counterparties in the transaction, but more broadly in society, which is what
Right.
this whole ESG thing is about. So I would absolutely say that this whole issue of public health and global health falls under the E and the S, and to some degree under the G, I suspect over time. It will be one of those things in which companies are measured,
But
for sure.
again, I guess, it's such a wonderful idea, but
No.
we probably don't have sufficient measures
No, we don't.
today.
This is the same challenge.
And
It's
that's
same
the
challenge.
challenge.
Right.
If there were measures that, you could then be trading bonds to reward those who are following, the best policies and that kind of thing.
No, but think about how our knowledge of health evolved. So Alfred and I used to work at the same firm. They had to defend some companies that had asbestos years and years ago in their products that create horrific problems in lungs, but no one knew it at the time. So
Right.
it's you have this externality and you have this, well, that wasn't external, but you have this problem of intertemporal knowledge of what works and what doesn't work from a health standpoint. We're discovering more and more about both negative and positive health outcomes. But how do you deal with that over the life of a company? And so you've put your finger on another one of these really tough areas.
So relating to that question, I think, again, so this decentralized crowdsourced information system might be able to at least, for example, if a company polluted and that caused a local health crisis or caused, food production issues, right? I think in the traditional setting, the poor villagers, they may now have a channel for them to voice, the situation, right? To voice the damages to them, right? So if we have a decentralized crowdsourced platform for them to have those information, right? To have those impacts recorded in the system in a transparent and public way, I think that will also, help us to better measure the environment and the social impact of companies.
And you should be linked to Rohit from the Judge School, who's created this startup that's attempting to measure impact in a positive way, but potentially negative as well. We talked about that the other day in class, right? So there's actually a student at the Judge School who's actually created a startup trying to measure local impact in a positive way, but one can flip that around and make it, the negative as well. So there's there's a lot of bit of entrepreneurial behavior around this, the kind of question you're talking about.
Good ideas, yeah.
A lot of great ideas. Yeah.
So if I may jump in here, you've made my life very easy by not having to do anything as the chair with a big flow of questions and answers. But it makes my life hard that I have to interrupt now and say, sorry, it's come to an end. I assume we're going to convene outside afterwards. I assume that's set up for us. But before we do so, I think we should thank the speakers with a large round of applause.